Hey everyone, welcome back to MarketSnap. Nokia is having one of the wildest years in tech, up 67% at one point, then down nearly 30% in 3 months, and insiders are quietly buying the dip. Before you chase this volatility, we're running it through MarketSnap's fair value model to see if the AI story is actually priced in or if the market has gotten ahead of itself. Let's dig in. Here's the setup. Nokia is no longer just the legacy telecom equipment player most people remember. It's pivoted hard into AI networking, cloud infrastructure, and data center connectivity, and that pivot is showing up in the numbers. But the stock's recent 28% drawdown has investors asking whether this is a buying opportunity or a falling knife. Today we're breaking down the business, the financials, the AI growth story, and what the valuation model says. Let's start with who we're dealing with. Nokia Oyj is a Finnish multinational founded back in 1865. Yes, this company predates the automobile. Headquartered in Espoo, Finland, with roughly 78,000 employees, Nokia operates across mobile networks, network infrastructure, cloud and network services, and Nokia Technologies, which handles patent licensing. The company serves telecom operators, enterprises, hyperscalers, and government entities worldwide. New CEO Justin Hotard took the helm recently, and he's steering the ship toward what management calls a new Nokia, one that's less dependent on the cyclical telecom capex cycle and more tied to the secular AI infrastructure build-out. Now let's talk revenue, because this is where the story gets interesting. In Q2 2026, Nokia reported 9% constant currency net sales growth, and the standout performer was network infrastructure, which is benefiting from AI-driven demand as hyperscalers and cloud providers build out massive data center capacity. The AI and cloud segment saw sales absolutely explode, up 105% year over year. That's not a typo. Meanwhile, the legacy fixed networks business is showing weakness, and overall telecom spending remains uneven as operators continue to be cautious with capex. On the earnings front, Q2 was a beat. Nokia topped profit estimates, with earnings per share coming in ahead of expectations. Revenue actually missed slightly, but the mix shift toward higher-margin AI and cloud products helped profitability. Gross margin came in around 44.6% on a TTM basis, which is solid for this industry. The company raised its outlook for the year, citing strong AI momentum and continued cost discipline. But here's the catch. Free cash flow turned negative in the quarter, and net cash declined. That's worth flagging because it means the growth is consuming working capital right now. Management commentary from the Q2 call reinforced this narrative. Executives pointed to strong demand from AI and cloud customers and highlighted progress on the strategy laid out at the Capital Markets Day. They emphasized that the company is focusing on areas where it can differentiate and create long-term value while managing supply chain constraints and market dynamics. The tone was confident but measured. They know the AI opportunity is real, but they also know execution is everything. Let's zoom out and look at the financial statements, because this is where the bull case gets tested. Full year 2025 revenue came in at about 19.9 billion euros, up from 19.2 billion in 2024. But here's the thing. Net income dropped from 1.28 billion in 2024 to just 651 million in 2025. That's a significant decline, and earnings per share fell from 23 cents to 11 cents. The company took charges and investments to reposition the business, and that hit the bottom line. Looking at the balance sheet, Nokia has about 5.5 billion in cash, total equity of roughly 21 billion, and a debt-to-equity ratio of just 0.16. Very conservative. The current ratio is 1.5, so liquidity is fine. The dividend yield is small, around 1.6%, but it's there. Now the market is pricing this stock at a trailing PE of about 69. That's expensive on trailing earnings, but forward estimates are much more constructive. Analysts expect earnings to nearly triple by 2028, which would bring the forward multiple down to something much more reasonable if the execution holds. Let's structure this with a proper SWOT analysis. Starting with strengths, Nokia has an iconic brand and a massive installed base of telecom infrastructure. Its patent portfolio is one of the strongest in the industry, generating high-margin licensing revenue. The AI and cloud segment is growing at triple-digit rates, and the company has a fortress balance sheet with minimal debt. Insiders are buying the stock, which is usually a decent signal. On weaknesses, the fixed networks business is declining, and the company's history of execution missteps has burned investors before. Free cash flow turned negative in the latest quarter, which is concerning. And the trailing earnings are weak, so the stock looks expensive on backward-looking metrics. Opportunities. The AI networking build-out is still in early innings. Hyperscalers are spending billions on data center infrastructure, and Nokia's partnership with NVIDIA positions it to capture a slice of that. The enterprise segment is another growth vector, as is the potential for 6G when the next wireless cycle arrives. And threats. Competition from Ericsson, Huawei, and a host of AI networking startups is intense. Telecom capex cycles are notoriously lumpy, and the company's guidance relies on perfect execution. There's also geopolitical risk, particularly around Huawei in certain markets and the broader US-China tech tensions. Now let's talk about the chart, because this is where the emotion comes in. The stock is up about 14% over the past month, but down over 33% in the past 3 months. Over the past year, it's up roughly 138%. So you've got a stock that tripled, then gave back a third of those gains. The 6-month performance is still up over 32%. So the long-term trend is intact, but the volatility is extreme. The stock trades around $10 near the lower end of its recent range. The 28% drawdown from the highs has brought it back to levels that look more reasonable from a valuation perspective, but the question is whether the selling is done or if there's more downside. All right, let's get into my take, because this is a genuinely interesting setup. Here's what our MarketSnap model spits out for Nokia. The fair value estimate comes to roughly $13, which is actually right around where the stock is trading today. The model blends a forward PE approach with a discounted cash flow analysis, and the output suggests the stock is roughly fairly valued, maybe a touch below fair value, maybe a touch above, depending on your assumptions. The 5-year CAGR projection is essentially flat, which means the model isn't seeing a massive margin of safety at current prices. But I want to be honest with you, this is one of those cases where the model output looks noisy. The AI growth story is real, but it's also creating a lot of uncertainty in the numbers. Our model had to make some significant assumption adjustments just to get to a plausible range. And that tells me you shouldn't hang your thesis on a precise fair value call here. If you disagree with our inputs, plug in your own growth or discount rate assumptions on our intrinsic value calculator at MarketSnap.com and see how the number shifts. My honest take is this. Nokia is a turnaround story with a real catalyst in AI networking. The triple-digit growth in that segment is impressive, and the NVIDIA partnership gives it credibility in the data center space. But this is not a stock you buy for the current earnings. You're buying it for the future earnings, and that requires a lot of trust in management's ability to execute. The free cash flow turning negative is a yellow flag. The fixed networks weakness is a structural headwind, and the stock's volatility suggests the market hasn't fully made up its mind about the story. If you're a long-term investor who believes the AI infrastructure build-out is a multi-year trend, Nokia at around $10 is probably a reasonable entry point, but it's not a screaming bargain. You're paying roughly fair value for a company that could go either way. The insider buying is encouraging, but insiders are often early. What do you think about NOK? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.